In another wild move on the market this week, Crocs shares are up 15% after the company reported a better than expected fourth quarter results for 2025. Now, to be clear, these weren't phenomenal results, but the expectations were set so low for Crocs that they were easily able to clear that hurdle. So I'm going to dig through all the numbers today and give you an idea of what I'm thinking about Crocs shares today. My name is Travis Hoyam. Thanks for watching Asymmetric Investing. Please subscribe here on YouTube for all my content. And thanks to this video sponsor, The Motley Fool. If you go to fool.com/ASYM, they'll give you their top 10 stocks to buy right now. Before I even get to the numbers for the fourth quarter, I want to put into some context why shares are up as much as they are. And it's because this was the guidance after the third quarter of 2025. Management expected fourth quarter revenue to be down 8% overall, down 3% at the Crocs brand, and down the mid 20% range for HEYDUDE. Earnings per share expected to be 182 to 192. So what did Crocs actually report? Well, much better than that. Revenue was only down 4% from a year ago. Crocs brand was flat, and HEYDUDE not down over 20%, but down 18% year over year. So if your expectations were set based on what their guidance was after the third quarter, yes, this quarter was much better than that. But here's the challenge, is it was not a good quarter. Revenue falling 4% is not good news for a company, especially a company like Crocs that a lot of investors think is in decline. What you want to see from any of these companies is that their brand is actually growing, and Crocs is not doing that. It's not doing that with the core Crocs brand, and it's not doing that with HEYDUDE. One of my theses with the company is Crocs is kind of like a foundation you can build on, growing slowly but surely over time. And then HEYDUDE is the potential for higher returns because that's a brand that's in decline. If they're actually able to turn that around and have an inflection point in that business, then the valuation can go much higher. But that's not actually what we're seeing. Now, the good news is Crocs is using the cash flow that's generated from the business, generated $659 million in free cash flow for the year, repurchased about 10% of their total shares outstanding. So that's what you want to see, is that they're buying back shares and they're paying down debt, returning cash to shareholders. But there's limits in your ability to do that if the business is in decline. And that's exactly what we're expecting for 2026. This is their guidance. Now, remember, they did sandbag their numbers a little bit for Q4, so very possible they're doing that for Q1 and for the rest of 2026. But they're expecting revenue to be down 3.5% to 5.5%, Crocs down low single digits, and HEYDUDE nowhere near the inflection point that we're hoping for, expecting revenue to fall 15 to 18% for the full year, even down 7 to 9%. So expecting things to get a little bit better, those comps get a little bit easier in the second half of the year. But even Crocs for the full year, just flat to up 2%. Thanks to our friends at The Motley Fool for sponsoring this video. Visit fool.com/ASYM for the top 10 stocks to buy right now. Now, you could be looking at this as a value play, given the current guidance for 2026, looking at a price to earnings multiple on a forward basis of about 7.5. That's not all that expensive. But if this is a business that's structurally in decline, then it's not going to be a great long-term investment for investors. So this is why the reaction by the market was so interesting. I looked at the results, and I always try to look at the results before I look at what the market reacted to, and I didn't see a lot of positives. Yes, they did beat their guidance, but overall, you don't want to see a brand like Crocs or even like HEYDUDE declining, especially on an ongoing basis. There's no real sign that HEYDUDE is going to be turning around anytime soon. That acquisition has been a complete disaster for Crocs. So this is one of those stocks that I own. I haven't bought in a very long time, and I bought it in part because the optionality for not only this being a value stock, but then potential turnaround in the business, that was what I saw as asymmetric potential. But the reality has not lived up to that potential expectation. So not ready to sell my shares yet, but definitely one that I'm considering going into the next few months. But let me know what you thought about the results and the market's reaction to Crocs results after Q4. Leave your comments in the comment section below. Don't forget to subscribe to Asymmetric Investing. Thanks for watching, everybody. See you here next time.